Hi, I'm Nagapraveen. This is a video lecture on IFRIC 12 Service Concession Arrangements. This interpretation is issued by ISB in November 2006. This interpretation is developed by Interpretation Committee of IFRS Foundation. In many countries, infrastructure for public services such as roads, bridges, tunnels, prisons, hospitals, airports, water distribution facilities, energy supply, and telecommunication networks has traditionally been constructed, operated, and maintained by the public sector, and they are financed through public budget appropriation. But in some countries, governments have introduced contractual service arrangements to attract private sector participation in the development, financing, operation, and maintenance of such infrastructure. Such an arrangement is often described as build, operate, transfer (BOT), or rehabilitate, operate, transfer, or a public to private service concession arrangement. Scope: an arrangement is within the scope of this interpretation if it involves a private sector entity constructing the infrastructure used to provide the public service or upgrading it, and operating and maintaining that infrastructure for a specified period of time. There are two parties in this arrangement: grantor and operator. Grantor is the person that grants the service arrangement. Grantor typically involves a public sector entity, including a governmental body, or a private sector entity to which the responsibility for the service has been devolved. Operator. Operator is the party to whom the arrangement is granted. Operator is responsible for the management of the infrastructure and related service, and it is obliged to hand over the infrastructure to the grantor at the end of the period of the arrangement. The operator is paid for its services over the period of the arrangement. This interpretation applies to public to private service concession arrangement if the grantor controls or regulates what services the operator must provide with infrastructure, to whom it must provide them, and at what price, or the grantor controls through ownership any significant residual interest in the infrastructure at the end of the arrangement. The issues covered by the interpretation are treatment of operators' rights over the infrastructure, recognition and measurement of arrangement consideration, how to account for construction or upgrade services, how to account for operation services, how to treat borrowing cost, subsequent accounting treatment, and how to treat items provided to the operator by the grantor. First one, treatment of operator rights over the infrastructure. The infrastructure shall not be treated as a property, plant, and equipment in the books of operator, as the contract does not convey right to control the infrastructure to the operator. The operator has only access to operate the infrastructure in accordance with the terms specified in the contract. I will explain all these principles with an example. First, I will cover all the principles, theoretical, then I will cover with a practical example. Recognition and measurement of arrangement consideration. Depending on the terms of arrangement, revenue shall be recognized according to IAS 11 or 18. The nature of the consideration determines its subsequent accounting treatment. In case of construction or upgrade services, the operator shall account for revenue and cost relating to this in accordance with IAS 11. Measurement of consideration. The consideration received or receivable by the operator shall be recognized at its fair value. The consideration may be either rights to financial asset or intangible asset. The consideration may be a rights to financial asset if there is an unconditional right to receive cash, if the grantor contractually guarantees to pay the operator either specified or determinable amounts or shortfall between amounts received from the users and the specified amount. We need to recognize the right to financial asset as per IFRS 9, either at amortized cost or measured at fair value through profit or loss. If the consideration receivable is in the form of intangible asset, we need to apply IAS 38. The operator shall recognize an intangible asset to the extent that it receives a right to charge users of public service. The consideration received or receivable shall be recognized initially at fair value of the consideration, received or receivable, even in case of intangible asset. For borrowing cost, we need to account it as per IAS 23. But if the operator has a contractual right to receive an intangible asset, borrowing cost attributable to this arrangement shall be capitalized during the construction phase of the arrangement in accordance with IAS 23. Items provided by the grantor to operator. Sometimes for some items, access is provided by the grantor. Please note that they are not property, plant and equipment in the books of operator. Sometimes the grantor may also provide other items to the operator that the other operator can keep or deal with it as it wishes. If such assets form part of consideration payable, then they are not government grants. They are recognized as assets of operator and measured at fair value on initial recognition. Sometimes there will be contractual obligations to restore the assets, to maintain the infrastructure to a specified level of serviceability, or obligation to restore the infrastructure to a specified condition before it is handed over to the grantor at the end of the service arrangement. We need to apply the principles of IAS 37. Now I will solve a simple problem on implementation of IFRIC 12. Please read the problem given below this video. X Limited enters into an arrangement with ABC government for the construction and maintenance of a road. The terms of the arrangement specifies that X Limited should construct the road within a period of 2 years, and it expects to receive from ABC government from the end of 3rd year till 10th year 200 million every year. X Limited estimate that the cost to construct the road will be first year 500 million, second year 600 million. If the same asset is constructed for a private party, X Limited will charge 1200 million. So the issue here is how to recognize and measure the construction of road in the books of X Limited. Please note that X Limited do not control the asset. It has only right to receive cash from ABC government. So X Limited should apply IAS 11 for the construction of the road and recognize the profit based on percentage of completion. The contract price is expected to receive from the agreement will be 1200 million based on price for similar assets, and the cost to construct the road estimated is 1100 million. So the profit 100 million will be recognized over a period of 2 years based on percentage of completion. Here I have calculated percentage of completion based on cost incurred till date to total estimated cost to construct. So the percentage of completion based on cost method is 45% in first year, 55% in second year, that you can see from the Excel. First year it is estimated that 500 million will be incurred. So 500 divided by total cost 1100, 45% percentage of completion. Second year 55%. So we need to recognize revenue and cost based on percentage of completion. So out of 1200 revenue, we need to recognize based on 45% at 545 million, 545.45 million first year, 654.55 million in second year. The receivable from the government will be treated as a financial asset, since we have the contractual right to receive cash from the government. So the entries that we pass in this case, first year debit cost 500 million, credit cash 500 million, since we have incurred cost to construct the road. Second year it will be 600 million, 600 million. Immediately we have to recognize at the end of first year and second year receivable from the government. We need to recognize revenue. So the revenue in first year is 545.45 million, second year 654.55 million. So the entries that we pass in first and second year for revenue is debit receivable from government, credit income 545.45, 654.55. The receivable from government will be treated as financial asset. So we need to apply IFRS 9 for the receivable. IFRS 9 says we need to account financial instrument either at amortized cost or fair value. We consider fair value only if we sell or transfer the asset to another party. So we need to account the receivable at amortized cost. So for calculating amortized cost, we need to know rate of return from the contract. The rate of return is calculated from IRR, internal rate of return. In this case, X Limited should receive 1200 million from government, whereas it receives 200 million for 8 years from the end of third year. So the IRR in this case is 6.17%, which you can see on the slide. At the end of first year, X Limited spent 500 million and revenue receivable is 545.45 million. But X Limited receives the consideration later from the end of third year. So we need to charge interest income on the amount of 545.45 million at IRR, which is 6.17% for second year, and on 1200 plus interest on second year for third year. From third year onwards, X receives 200 million. So I prepared a loan schedule for this purpose. In this schedule, for year 1, X Limited has spent 500 million and expects to receive 545 million from government. So the asset at the end of financial asset at the end of first year is 545.45 million. Second year it has spent 654 million. Now in second year it will charge interest at 6.17% on opening balance. So closing at the end of second year is 1233 million. From third year onwards, it charges interest on opening balance and it gets payment of 200 million from government. So this schedule will continue like this. At the end of 10th year, there will be closing balance of 0. So it receives entire amount from government. At the same point of time, X Limited will transfer the road to government. So total consideration receivable from government is 1600, out of which 1200 is towards revenue, which we have booked in first and second year, and remaining 400 is interest. So the interest to be booked every year is given in the schedule. The entries that we pass for the interest income are debit financial asset, that is receivable from government, credit interest income. So I summarize for the consideration receivable in the form of financial asset. We apply the principles of IS 11 or 18 and recognize revenue and cost based on percentage of completion. The consideration will be accounted as per IFRS 9, either at amortized cost or at fair value. Now let's consider in the same example, the ABC government says that it will not pay a single buck but grants the right to collect money from the public to X Limited. The public will be using the road, so X Limited will collect money from the public through toll collection. Then in this case, the consideration is receivable in the form of intangible asset. So we need to apply IAS 38. So the cost of intangible asset as per IAS 38 in this case is the fair value of the consideration receivable, which is 1200 million. X Limited expects to receive 1200 million. So 1200 million is the cost of intangible asset. For subsequent measurement, we amortize the intangible asset over the period of the agreement. So X Limited will book expenditure 1200 divided by 8. It will be 150 million for every year. And X Limited will get income in the form of toll collections. For that, we recognize revenue as and when we receive. The entries that we pass for consideration receivable in the form of intangible assets are, for the first year and second year, the entries will be same even if it in the case of financial asset or intangible asset, but only difference is between consideration receivable. So for cost incurred, we pass the same entry: cost debit credit cash 500 500 first year, second year 600 600. For income, we need to recognize intangible asset, debit intangible asset credit income. First year it will be 545.45, second year 654.55. So total intangible asset at the end of second year is 1200. So profit we recognize will be 100. This is as per IAS 11. profit will be as per IAS 11, revenue will be as per IAS 11, cost as per IAS 11, intangible asset will be as per IAS 38. So if it is intangible asset, then we need to apply the principles of IAS 38. As per IAS 38, we need to amortize intangible asset. So we will amortize intangible asset over the period of the arrangement. So we will amortize it from the 3rd year till 10th year. So amortization for each year is 150. And whenever we receive income in the form of toll collection, we book revenue. So entry for this is cash debit credit income 200 200.